Good afternoon, ladies and gentlemen. Thank you for participating in Bullion Management Group's Gold is for Real Wealth Preservation, Not Speculation, live webinar with guest speaker David Ranson. And now we'd like to welcome our host, Nick Barisheff, President and CEO of Bullion Management Group, Incorporated. Please begin, Mr. Barisheff.
Good afternoon. I'd like to thank you for participating in today's webinar. I know this is a busy time for everyone. Today's webinar will begin with a 45-minute presentation by David Ranson, followed with a brief introduction to our new exclusive association with our Alliance Trust by Mark Farmer, our Vice President of Bullion Bars program. After that, we'll open up to a question and answer session. You can submit your questions through the Q&A feature on your screen at any time during the presentation. It is our great privilege to have David Ranson, President and Director of Research of Wainwright Economics, joining us today for this webinar. Wainwright Economics is an investment research and strategy firm which for over 30 years has helped the institutional investment community in devising effective investment strategies through intelligent use of market data and superior understanding of how markets behave over time. David has taught economics at the University of Chicago Graduate School of Business, has been the assistant to former Treasury Secretary William E. Simon. He has provided testimony to a number of congressional committees. His work has appeared in the Wall Street Journal, the New York Times, and various other publications. He holds a master's and a BSc degree from Queen's College, Oxford, and an MBA in finance and a PhD in business economics from the University of Chicago. So it is really my pleasure to introduce to you David Ranson.
Thank you very much, Nick. It's good of you to have me on your show. Well, my presentation is oriented around a whole bunch of illustrations. I'd like to start with the thought that investors are right to pay increasing attention to gold, but I would say its role in the economy and the capital markets is still greatly underappreciated. Some use the price of gold as an indicator of currency depreciation and an inflation warning. But that's controversial, especially in the United States, where the consumer price index is barely moving. And I'll have a lot to say about this later. Investors are also influenced by academics and policymakers. They've long tried to exclude gold from the monetary system, and they continue to deny its economic significance. Many investors also view gold as an investment in its own right, but there are plenty of critics of that too. My thesis will be that gold is legitimate and valuable, both as an economic indicator and as an investment option. So could we move to the first slide, please, Courtney? In recent times, North American investors have lost sight of the connection between the price of gold and the cost of living. And there are several reasons for this unawareness. The main one is simply a short collective memory. So here's the first of my illustrations showing the long-range parallel between gold and consumer prices, all the way back to almost the beginning of the 19th century. The relationship remains intact today, at least in my opinion, but you can see a new and increasing disconnect in the last few years. Reasons for the disconnect include the long time lag that separates market prices like gold from estimates of price levels produced by government statisticians, and the delays are quite particularly long in the United States. The CPI in the U.S. has been re-engineered on many occasions, and these modifications change the speed with which it moves, mostly downward. To portray the CPI, as everyone does, as if it were a single statistic with a history of nearly 200 years, is not technically valid. It would have been better in my chart to show it as a tacking together of a sequence of separate indices, each of which behaves differently. In fact, every time the government has overhauled the CPI, the resulting index has been stickier and less responsive to current events. So that's the picture in the United States, where historically the currency has been stable most of the time. In other countries, especially where currencies are unstable, this parallel between the local currency price of gold and the cost of living is a great deal more apparent. If we could go to the next slide, Figure 2 shows the case of Argentina in the post-war period. And during these years, the price of gold rose and the currency fell cumulatively by 13 powers of 10. It'd be hard to find any other country where we could get a larger mathematical number than that. This chart shows a cost of living that more than keeps up with the decline in the currency. A survey of emerging market currencies with various degrees of instability uncovers a neat long-term relationship that encompasses all of them. And that's shown in the next slide, Figure 3. It's a pattern of near-perfect proportionality that illustrates one of the major irregularities in all of economics. It's sometimes known as the law of one price. This stipulates that freely changing prices are directly proportional to the performance of the currency in which they're expressed. Inversely, of course. Now, when currencies are stable, this relationship is moot and not visible. The law of one price applies to developed countries to a lesser extent, therefore, because their currencies have been more stable. But it still applies when their currencies are changed. And the next slide, Figure 4, shows a similar fit that we had for the emerging countries, in this case for the developed countries, covering the floating exchange rate period from 1972 to the present. The degree of currency change in this sample, of course, is far less than in the last slide. In this time frame, the price of gold has been a moving target. It's especially a moving target today, and there's not yet been enough time for all of these indexes of consumer prices to adjust and catch up. And that's why the slope of a least squares line, I think you can see we've put a least squares line in the graph, the slope is only about 0.75. But if you use longer and longer time frames, you get slopes that are closer and closer to 1.0. So what do we gather from all of this? The evidence makes it plain that inflation, and especially high and variable inflation, is more than anything else a currency phenomenon. Next slide, please. However definitive the evidence, this link between currency depreciation and inflation is playing a relatively small role in the thinking of our current policymakers. Some of them, in fact, are oblivious to it. This is why the media, and ultimately so many investors as well, are confused about what exactly inflation is. I've been using the word inflation up to the moment as the cost of living. But it's useful to think about where a number of other ideas about the nature and the origin of inflation fit in. And some of the most important of these indicators are listed on the next slide. That's Figure 5. Although every item in the list has some value as an indicator of inflation, I'm going to argue that all, except the last one, also suffer from serious deficiencies. So let's start with the man on the street for whom inflation is nothing more than a rise in the cost of living. And think about that. Actually, prices for consumers are only one aspect of the general price level. It's the one we hear most about. But there are other aspects, including wholesale prices, industrial prices, commodity prices, and others. And these different groups of prices don't move in close parallel all the time because some are much more flexible than others are. It's natural, but it is slightly misleading for government policymakers and the news media to concentrate so much of their attention on consumers, because the other prices in the system could be equally important. It's especially unwise for investors to follow suit and act, for example, as if there is no inflation threat at all when the cost of living index is not rising. It's a mistake where the official index has been engineered to show low inflation, and it's also a mistake where the globalization of consumer good production is forcing slowly consumer prices down. The consumer price inflation rate is a very slow-moving indicator relative to the currency depreciation of which it's a symptom. Investors should not make any investment decisions based on it. The second widely watched indicator in my list is a rise in labor costs. I still hear claims that inflation is not an economic problem until the cost of labor is rising rapidly, which is certainly not the case now. But wages have always lagged behind the cost of living, and they can never therefore be a timely indicator of inflation. Not only that, but this time around, globalization is obviously forcing wages down as well. Another quite different definition of inflation is a rapid rise in the money supply. It stands to reason there must be some connection between the value of money and the quantity of money. But this is a bad idea. The reason is that it may be an inverse indicator in practice. If we could look at the next slide, figure 6, you'll see an example. This shows an analysis of MZM, or money of zero maturity, which is a standard measure of cash in circulation in the U.S. economy. In this table, we divided the history of MZM growth into high, intermediate, and low categories, and then we looked at the average inflation rate, measured 2 or 3 different ways, in each category. And you see, it's an inverse relationship. We also found that most measures of money in circulation are much more closely correlated with the rate at which the economy is growing than they are with the rising cost of living. Could we go back to the previous slide, please? The next indicator on our list is rising interest rates. Historically, these are correlated with both the dollar's depreciation and the rise in the cost of living. But there are several reasons why they are unreliable inflation indicators, particularly today. One is that central banks are actively involved in manipulating interest rates. They always did, but much more so now, so that rates are not free to reflect market opinion. At times like the present, the exceptionally low level of interest rates doesn't necessarily mean the absence of inflation, but it reflects other Fed concerns such as systemic collapse and the financial condition of the banking system. And even when interest rates are set in a free market, they're always a lagging indicator. In any case, the yield to maturity of a bond is not a measure of actual inflation, it's a measure of expected inflation. So for all these reasons, interest rates have lost whatever power they had in the past to provide a warning of inflation on the way. The next indicator on the list certainly does freely reflect market opinion. It's the shifting performance edge between paper investments like stocks and bonds and physical assets such as real estate and commodities. The general idea is that when physical assets outperform paper assets is a sure sign of inflation. And this is absolutely true. The disadvantage is that different assets perform differently, and some of them are simultaneously being driven by other economic factors. So you can't really pinpoint the inflation rate by looking at these kinds of data. Well, let's sum up so far. We've got many symptoms of inflation, but they may not make good leading indicators for various reasons. Warning of inflation will appear earliest in the dollar's performance as a currency unit. We can express the dollar in terms of several alternative benchmarks: foreign exchange, commodities, precious metals, gold specifically. Currency movements are fast-moving and timely indicators of the dollar, but different currencies may tell different stories. That reflects the fact that each national currency is a paper asset reflecting the creditworthiness of the issuing government. In any case, exchange rates tell a lot about relative inflation, but they're not direct measurements of absolute inflation. It is better, therefore, to express the dollar's depreciation in terms of physical assets and not paper assets. We want to use commodities or precious metals or gold. But there are still 2 more obstacles to overcome. Different commodities also tell different stories. All commodity prices are susceptible to changes in the economy's performance, but some are more sensitive and others less. Precious metals, such as silver and platinum, are no exception. In fact, they're among the more sensitive metals or more sensitive commodity prices. So by a lengthy process of elimination, we are left with the price of gold as the single best measure of inflation. I believe it is the best measure for the purpose of making investment decisions in particular. Its price is set by the market, ambiguity is at a minimum, it's sensitive, it's timely, it's a leading indicator of all the other symptoms and indicators of inflation that I've been talking about, and it's not vulnerable to a sag in the economy. So at one end of the scale, we've got gold, and at the other end of the scale, we've got the Consumer Price Index. And as we've already seen, consumer prices and the price of gold eventually converge, but the difference in timing is enormous, and that's shown in the next slide, Figure 7. Figure 7 analyzes how long it takes for the U.S. Consumer Price Index to respond to a change in the gold price. Now, I'll have to explain this chart carefully. In the upper chart, we divided the history into years in which the price of gold rose and years in which the price of gold fell. And those two lines show the path of the Consumer Price Index. Obviously, the CPI rises much faster after the gold price has risen and much slower after it's fallen. And you can look at the divergence between these two CPI trajectories. It keeps widening for years, and towards the end of the graph, it appears to be approaching something like 28% eventually. 28% is the difference between the gold price scenarios. In the lower chart, this divergence is plotted as a function of time, suggesting that it takes more than 5 years for just half of the ultimate response to show up. Allowing for a difference of 5 years, in the next slide, Figure 8, we are showing there the dollar price of gold and the US CPI really do move in parallel over time. This chart compares the 5-year change in gold with the 5-year change in the CPI. And the broken line depicting the gold price has been shifted 5 years to the right to bring the two lines into rough conformity. Next slide, please. People are far more aware of the effect on their lives of a rise in the price of oil, or an energy generally, than in the price of gold. Oil has an obvious role in the economy. It's far the most important of all commodities, and its price is the one that gets the most attention from investors and the media. If we were to use one single asset as a measure of inflation, many people might be inclined to use oil rather than gold. Gold is one of those commodities that gets in the news only when its price is changing dramatically, while oil prices are watched closely even when they're stable. But there are several ways in which the gold price provides more accurate information about inflation than the oil price. Correlations between oil price changes and producer price or consumer price inflation a year ahead are much lower than those for gold. You can see this in the next slide, Figure 9. Furthermore, when oil price and gold price data are included in a single statistical test to anticipate inflation, it's only the gold variable that is statistically significant. Another way to test oil and gold against each other is to look at their implications for interest rates. Precisely because it anticipates inflation so well, gold is also a powerful predictor of interest rates. The next slide is Figure 10, and that demonstrates how unhelpful oil price movements are in predicting bond market performance. The bars show the responses of the bond market to different combinations of rises or declines in either oil or gold. The point to notice is that when gold has risen more than 10%, bond yields rose to the same extent regardless of whatever the oil price did. And in general, throughout the graph, it's clear that the gold price is the better measure, or the better predictor of the bond market response. Going to the next slide, Figure 11, we can portray a triangular relationship between oil, gold, and bonds. The diagram points out that the relationship between oil and bonds is roughly contemporaneous. Gold is correlated with both of them, but it moves in advance of both by a year. So what is it then that gives gold such superior properties? Unlike oil and other commodities that are produced only to be consumed, gold is produced almost exclusively for accumulation. Gold is different because the reservoir of it that is tradable in world markets dwarfs any possible interruptions in the annual flow that results from either industrial demand or supply changes. The annual flow of newly mined gold adds less than 2% to the accumulated gold supply, far less than for any other commodity. What the existence of this reservoir does is to stabilize the purchasing power of gold in terms of other goods. The gold is essentially always there, and it allows the gold price to be a good barometer of changing currency values. Ultimately, that means it's a barometer of changes in the absolute level of prices. But the main purpose of oil is the production of energy, and to use it for that purpose, it's necessary to consume it totally, literally to destroy it in the process of converting it to energy along with water and carbon dioxide. And that makes the real value of oil much more variable than the real value of gold. The relative variability of oil is visible in the ratio between the prices of oil and gold, which has been something like a natural constant. Many people watch it over the long haul, but it fluctuates, of course. The next slide illustrates the way that the price of gold has revolved around movements in the price of gold back before about 10 to 20 years ago. My conclusion is that the gold price reflects inflationary pressures in general, but the oil price also contains information that's specific to the energy sector. In short, the gold price is a reliable barometer of the value of the dollar, and the oil price is not. Next slide, please. So as a market signal, the primary role that gold can play is to detect and measure a change in the real value of the dollar and other currencies. But it also has a secondary role as a benchmark for valuing other assets to determine whether they are cheap or dear by historical standards. And the price of silver relative to gold is a good example of that. And it provides a valuation indicator for silver. In the next slide, figure 13a, the graph shows the price ratio between the two metals back to the middle of the 19th century. Investors would expect that silver is much more likely to appreciate in price when its ratio to gold is historically low than when it's high. The following slide, figure 13b, confirms this, and it also provides an idea of how long it takes for the silver-gold ratio to reapproach its trend line after it's gone somewhere else. A more important application of the same thinking concerns the Dow Gold, or S&P Gold ratio, and the history of that is shown in the next slide, figure 14. This is a history long enough to demonstrate that over the long haul, equity prices outperform the gold price, and we have to allow for that in figuring out the norm for the ratio. The following slide, figure 15, divides the history into groups of specific years according to how high or low the ratio then was relative to the trend line. The result is a very interesting but unsymmetrical pattern. The stock market performs superbly when it is extremely cheap according to this ratio, but the market does not perform particularly badly when it's extremely dear. So it's not a very straightforward valuation indicator. The following slide, figure 16, shows how long it takes for the stocks to gold ratio to reconverge to its long-term trend after it has diverged. It takes about 9 years, as you can see, to achieve complete convergence. So the price ratio of stocks to gold can be informative about the future course of the stock market, but it doesn't move very fast. Next slide, please. Many investors think of gold as a risky asset because its price, expressed in paper money, has been volatile in modern times. But this is mostly an illusion due to the instability of the currency. It has long been known that the purchasing power of gold is roughly constant over extremely long periods of time. And thoughtful investors should be treating gold as a very safe asset. By and large, markets do that. Gold also has other kinds of safety properties. For example, the market for bullion is worldwide in scope and it's very liquid. During the last few months of 2008, while the U.S. economy was on the verge of collapse, commodity prices fell across the board by as much as 50 or 60% in many cases. But gold fell much less and bounced back to its pre-crisis level within weeks. This was a pretty good test of the stability and resilience of an investment in gold. But we've got a more comprehensive test appearing in the next slide, figure 17. Here we list a wide range of economic and financial variables that provide danger signals for investors. It's evident that in most cases gold produces positive returns under extreme circumstances. In the next slide, figure 18, we estimate how the return from gold is correlated with the performance of stocks or bonds when those assets are producing their most negative returns. So in this slide you can see the final column in the table is the one I'm really talking about. That's the important one. When you see there, gold is negatively correlated with both bonds and stocks during the quarters in which they perform badly. So it tends to compensate for losses in the other two assets during these periods. So let's take together the evidence in the last two slides. We can see gold is an extremely helpful asset to include in portfolios through thick and thin. Could I have the next slide, please? When it comes to inflation, Wall Street tends to be late seeing it coming. And that's partly, as I mentioned, because of the widespread obsession with the consumer price index, which is so lacking in timeliness. And while the price of gold has been signaling a return of inflation for quite a few years now, but it is taking Wall Street a long time to fully recognize it. Portfolio managers are beginning to seek investments with which they can protect themselves from the pernicious effects of this inflation. And the two leading candidates, of course, are gold and index-linked bonds. In the U.S., they're called TIPS, and they're indexed to the CPI. To the extent that investors can anticipate that the CPI is about to climb more rapidly, TIPS prices should be driven up. But we can see to what extent that happens in the next slide, figure 19, and we find it does not, in fact, work that way. The chart demonstrates that higher returns from TIPS actually are followed by lower CPI inflation and vice versa. This result might seem extremely surprising, but it can be explained if the CPI is as inadequate a measure of inflation as I've been arguing. When inflation is actually imminent, the rise in the CPI is going to be a pale and late arriving reflection of it. And TIPS are protected against the changes in the CPI itself, but they're not protected against the full amount of inflation of which it is a reflection. TIPS prices so therefore fall instead of rising. In other words, in the face of inflation, they behave exactly as regular Treasury bonds do. Next slide, please. When investors seek a hedge against the depreciation of the dollar and its inflationary consequences, they might also consider commodity futures as another alternative to gold. Both gold and the Goldman Sachs Commodity Index, the GSCI, are assets that can be mixed into a portfolio and whose annual returns are inversely correlated with the performance of stocks and bonds. My next slide is figure 20, and it compares gold with the GSCI in its role as a possible hedge for bond portfolios. The impact of GSCI on bond returns over a 2-year period is seen if you just compare each gold-colored bar in the chart with the green bar to the left of it. But the impact of gold is seen by comparing the 2 bars on the right of the chart with the 2 bars on the left of the chart. By this test, gold is 3 times better than the GSCI for hedging a bonds portfolio. The following slide is figure 21, repeating these calculations for the stock market. And again, the data show that gold is the better hedge. There's an inconsistency in the chart. The green bar is sometimes higher than the gold bar, sometimes lower. That's actually an inconsistency in the role that the GSCI plays. It doesn't have an inconsistently inverse correlation with stocks. Sometimes it's a positive correlation with stocks. But gold always has a consistently inverse correlation with stocks. Can I have the next slide, please? When gold is added to a fixed income portfolio, it greatly improves the ratio of return to risk because bond price movements are inversely correlated with the changing price of gold. We have to allow for the fact that it takes up to 2 years for the impact to be fully felt, and that's shown in the next slide, figure 22. If you observe the difference, or the divergence, I should say, between the two lines, it stops widening after year number 2. So we need a 2-year time frame. The following slide, figure 23, looks at the portfolio's ratio of risk to return as the amount of gold in the mix varies between 0 and 100%. The ratio is maximized when the percentage of gold is 21%, and that's good to know. But it's not the same thing as producing a portfolio that's immune to inflation. In fact, we get an even more favorable result. In the next slide, figure 24, we use the 2-year cumulative change in the price of gold to measure the damage done by inflation to the annual performance of a T-bond portfolio. And the diagram shows the sensitivity of portfolio returns to a 1 percentage point change in the gold price for portfolios with different gold content. As you can see, the sensitivity, it passes through the 0 line. It's almost exactly 0 at a mix of 15% gold and 85% treasury bonds. I would argue that's equivalent to providing 100% protection to a bond portfolio against inflation. Next slide, please. Much the same can be said about hedging an equities portfolio against inflation, although the details are a bit different. Price movements in the broad equity market are inversely correlated with gold, as shown in the next slide. That's figure 25. But in this case, the delay in response lasts several years, and that's shown by the widening divergence between the two lines. So in the following slide, figure 26, we use the 5-year cumulative change in the gold price instead of the 2-year change to measure the damage done to the portfolio from inflation. The diagram shows that the sensitivity of the portfolio is 0 when it contains, again, 15% gold and 85% equities. It's an odd coincidence that this same gold component, 15%, is the right amount to immunize either a T-bond portfolio or a U.S. equity portfolio against inflation. Next slide, please. Many talking heads are warning that owning gold constitutes speculation rather than investment. But there isn't really any analytical distinction. All investment involves risk, and all investment is to some extent speculative. Of course, some investment vehicles are more volatile than others. But I would say gold is only superficially a volatile asset. It seems that way because we measure its performance in terms of dollars. While it's a universal convention to express prices and investment performance in dollar terms, the conventionality of a practice is no guarantee of its validity. Fictive conventions can seriously mislead otherwise thoughtful people. The value of gold has always been recognized as extraordinarily stable in real terms. Measured in US dollars, the price of gold can either be stable, as it was in the gold standard era, or unstable, as it's been since about 1970. And these days it often jumps around from one week to the next. But year to year it's very consistent, and that's shown in the next slide, figure 27, encompassing the last 10 years. The gold price has fluctuated within quite a narrow channel around its strong upward trend. I would not agree that gold is either an inferior investment, as its detractors keep saying, or a superior investment, as some of its fans claim. At any one time, gold may be a superior or an inferior investment, or anything in between. It depends on economic conditions. Times when gold is inferior, assets that are defined by paper money contracts, such as stocks and bonds, are superior. But when gold is superior, as it is now, bonds and stocks are inferior. And my final slide illustrates the inverse connection between the two, allowing for a delay of only 1 year for the effect to be felt. You see in figure 28, we get impressive inverse differences in performance. How about the claim that gold is not a natural investment because it has no intrinsic value or quotes, offers no income, no dividend, no earnings, end quote. Well, if you think about it, the same can be said about a treasury bill or zero coupon bond. Either of these offers return of principal plus capital gain, no income. Both of the return of principal and the capital gain are nearly certain in nominal terms, but of course they're both uncertain in real terms. Now what gold offers is almost exactly the converse. The return of principal plus capital gain without income, both uncertain in nominal terms, but both nearly certain in real terms. To invest in such an asset is no speculation, but it's a sure way to preserve wealth. And at this point, I'm very happy to turn the floor back to Nick.
Well, at this time, I'd like to introduce Mark Farmer to give us a slight introduction to our new association with Alliance Trust.
Thanks, Nick. Good afternoon, everyone. It's Mark Farmer, and I'm the Vice President of Business Development for the BMG Bullion Bars program. Just before handing you over to the Q&A portion of the presentation, I want to take this moment to announce that Bullion Management Group, BMG, has now entered into an exclusive agreement with the Alliance Trust Company of Nevada to provide market transaction services together with allocated and insured storage services for the ATC range of collective trust funds. Collective trust funds, known as CTS, are now enjoying a significant renewal of interest in the United States, given their low overhead structure and the high level of fiduciary oversight regulated by the Office of the Comptroller of the Currency in the USA. BMG provides investors with the ability to purchase and store certified gold, silver, and platinum precious metals bullion on an allocated and insured basis in the main vault at the Bank of Nova Scotia in Toronto, Canada. BMG offers a diverse range of bullion products that includes its two registered open-end mutual fund trusts, the BMG Bullion Fund, this is our original silver, gold, and platinum fund, and the BMG Gold Bullion Fund that purchases only gold bullion. In addition, BMG offers individuals and institutions alike our specific bar ownership and allocated storage program called the BMG Bullion Bars. Because of the high level of security and transparency offered by BMG products, Alliance Trust Company has selected BMG to exclusively provide transactional, administrative, and co-custodial services for its 5 new collective trust funds. These 5 funds are focused exclusively on BMG bullion products and are designed to provide the safest and most direct method of acquiring and storing physical precious metals bullion for institutional-level investors. The selection of ATC funds intends on providing a safe and efficient manner to purchase, redeem, and to store significant levels of physical precious metals bullion with no constraints as to liquidity or storage capacity. Many institutions are currently underexposed to precious metals, and we anticipate that it will require access to significant volumes of bullion in order to simply rebalance their positions. The Alliance Trust funds provide this service, allowing for immediate access to the largest physical bullion trading market in the world, the LBMA, and can in this manner ensure that there are no liquidity or capacity constraints for institutional clients wanting to rebalance their risk by securing a proper exposure to unencumbered physical precious metals. Canada offers the perfect jurisdiction for bullion storage, and the Bank of Nova Scotia's main vault ranks at the highest level of security available in the world today. For further information on the Alliance Trust Company group of collective funds, please visit their site at www.atctrustfunds.com or call 888-950-0049. Thank you very much for your time, and with no further delay, I invite you to enjoy the Q&A section of the webinar.
Well, thank you, Mark, and thank you, David. We have quite a number of questions, and we'll go through as many as we can. In case we don't answer all of them, please feel free to contact us, and we'll attempt to have them answered in due course over time. So maybe, Mark, you can direct some of the questions that we have.
Okay, first question. Dr. Ranson, assuming oil continues to rise, which causes a global recession, what's your estimate of the impact on silver prices due to their use in many industrial applications?
Well, the silver price should continue to rise without any particular connection to recessions, because silver has been extremely cheap relative to gold. As of the fall of 2008, it was one of the metals that fell more than 50% relative to gold during that time frame, and it's climbed very far back, but I don't believe it's climbed all the way to a natural ratio of the kind that we were seeing in one of my exhibits. So I would say that as silver becomes more expensive, it's actually returning to normal, and it's a long way yet from becoming so expensive that it would force anyone to make major adjustments in the way silver is used in the economy.
Maybe one of my questions, David, is that with silver has two attributes as an industrial commodity and as a monetary metal. And if gold's rise continues from a monetary point of view, do you expect that silver would also follow in that respect as it did in the 70s?
Certainly I would, yes. That's two reasons for silver to rise. One is to catch up to the normal ratio with gold, and the other is, as you say, to follow gold as the dollar is declining.
Okay, next question. During rising inflation in the 70s and rising rates, it seems counterintuitive that less gold is required to immunize a bond portfolio than required to immunize an equity portfolio. Can you please elaborate?
Well, I gave the same percentage, actually, 15%. I believe that if you have a portfolio of either equities or bonds, but 15% of the portfolio is occupied by bullion, then both portfolios will have rough independence of any further change in the gold price, which I believe is a necessary condition for any inflation in the future. I can't really comment on why the percentage is 15% or why it should be higher for bonds than for stocks, or lower for bonds than for stocks, or the same for both. I'm afraid I simply have no answer to that question.
Okay. Next question. What are your thoughts on silver as a leading indicator of inflation, given the strong industrial demand combined with rising monetary demand?
Yes, well, that's a good point, very much along the same lines. You can't really use silver as a good indicator of inflation if you've got fluctuating industrial demand or fluctuating conditions in industrial activity. All of those things will contaminate its price, cause movements in its price that have nothing to do with inflation, and so that will degrade its ability to function as a good indicator. And that's the reason I was stressing that gold is the only one soldier left standing. When I went through all of those different symptoms and indicators of inflation, silver was the last one to fall for this exact reason.
Okay, next question. Correlation of gold to inflation. Are your figures based on the CPI X food and X energy? CPI is really understated, excluding these amounts.
I could have used a lot of different CPIs and essentially got the same sorts of results, but the CPI that I did use was the official headline index, which does include energy, and it has not been modified in any way.
Okay, next question, David. You mentioned that an increase in the money supply is not a strong indicator of inflation. Can you please explain that a bit further?
Yes, well, money goes into circulation potentially for two reasons. One is that the Fed pushes it into the banking system, and the banks push it out in the process of creating loans. The other way that money gets into the circulation is because there's a demand for money on the part of people who use it, and they go get it from the banks. So money can be sucked out of the banking system or pushed into circulation by the banking system. Now, if money is sucked out of the banking system, that means it's going to depend on the growth rate of the economy. As the economy grows, more demand for money, more money goes into circulation, and the banks are acting as passive partners in the process. And that's exactly what we do see in the correlations. I didn't show you the correlation for growth of the real economy, but there's a strong positive correlation between the increase in the money supply and the growth of the economy. And I believe the reason we get a negative correlation with the inflation rate is partly the mismeasurement of the inflation rate, but it's also partly the fact that the more growth you have, the less inflation you get. On the whole, the growth rate of the economy and the inflation rate in the economy are inversely correlated.
Okay. Next question, David. Isn't gold rising because the U.S. dollar is falling, is the comment. Once U.S. economy turns around, could this be the end of the gold run?
Well, first of all, the first statement is absolutely right. It's virtually a tautology as I interpret it. The only reason why the price of gold is rising is the decline in the dollar. I don't think that gold is changing relative to the economy in any significant way. It doesn't relate to the economy because gold isn't used industrially. So a rise in the price of gold is just another way of looking at a decline in the dollar. But the second part of the question implies that the dollar is on the decline because the economy isn't doing well. Well, actually, the dollar can decline during all kinds of economic performance, and there's really no connection of that kind. If anything, a rise in the price of gold, reflecting a decline in the dollar, tends to lead in the future to an economy that does not do well, and the causation goes in that direction rather than the direction suggested. So I don't think there's any likely change or turnaround in the value of the dollar, even if the economy does better for some reason. It could, for all sorts of different reasons, do better, although I'm not expecting any of them to turn out. It could happen. I don't believe this will turn the dollar's decline around at all.
Next question. If you compare the hedging capacity of gold against the rise in cost of living as measured by John Williams' shadow government statistics numbers?
No, I could use the Williams figure for the CPI. Actually, Williams has many different indexes because each index is tied to one particular method that the government used at some particular time in the past to measure prices. So there are many different indexes one could use, but the answer to the question is no, I haven't tried those in those correlations.
Thank you. Next question. What is the natural gold-silver ratio?
Well, it changes over time. Let me go back to the chart looking at to display that. The natural ratio in terms of silver per ounce of gold is approximately 65, according to figure 30A, if you extrapolate that dotted blue line to the end of the graph around 2011. Hello, can you hear me?
Yes. Yes.
Yes.
Ray Dalio of Bridgewater recently called for an inevitable change of the U.S. dollar as the world's reserve currency. How would gold and silver react in that type of an environment?
the U.S. dollar is demoted from its position as the world's reserve currency, I don't see any reason for the price of gold to behave very much differently. If anything, the rise in gold might accelerate because as the U.S. dollar becomes a less and less credible currency, there's less and less demand for it, and one of the supports to its real value is removed, and that would allow it to fall even more rapidly than it presently is falling. But I don't think there'd be a tremendous change, and indeed the dollar is losing its function as the world's reserve currency as we speak. Nobody's going to be able to prevent that from happening as long as it performs as badly as it's performing.
Okay, next question. Shadow Stats reports inflation at a level far above the official CPI rate. This discrepancy is becoming too large for the average person to ignore. Further, unemployment is much, much higher than reported. How long can the numbers be believed?
Well, I very much ask the same question. I think they're already subject to a lot of disbelief. More and more people are becoming aware of how unrealistic they are. But there's always an awful lot of people who are content to accept what the government tells them and take the official numbers as the right numbers. I would say people wake up very slowly, and we are going through a process where people are waking up, but it takes an awful long time before we're all wide awake.
Okay. David, for clients with a balanced portfolio of 30 to 40% fixed income and 60 to 70% equity, what would you recommend as a gold and silver allocation to protect this portfolio?
Okay, there are two possible interpretations of the question. If we're interested in strict protection of the portfolio against inflation, then the same percentage that I've suggested would apply. If 15% is the right input of gold in a fixed income portfolio, and it also by accident happens to be about the same right input for an equities portfolio, then any mix of equities and bonds can be immunized by the same percentage of gold. But a broader interpretation of the question would be, if you want to protect the portfolio against the loss or the opportunity loss that you get from having the economy behave in the way it will behave under the circumstances of a declining dollar, then you'd probably want to put a much larger fraction of the portfolio into physical assets. Gold would only be one of them, but you'd want a diversified portfolio that includes a lot more than just stocks and bonds. And in that case, you would be protected in a more deep way. That is, you would be able to get a positive real return rather than simply zero.
Okay. And our last question. David, what are the historical relationships between gold and other commodities now?
Well, all commodities rise or occasionally less often fall as the price of gold rises, but in arrears. So the historical correlations between commodity prices and gold, I think, have never changed. As far as I can see, they're much the same going back over the last 200 years of U.S. history. You can't see the correlation when the price of gold is stable, but whenever the price of gold has changed, you can see the effect on commodities. And basically, all commodities rise pretty much in sync with gold, but with a delay, and the delay may be as long as a couple of years, probably at the most.
Well, thank you, David, and I'm sure everybody's got some new insights in terms of what you presented today. David has been kind enough to allow us to share his report, Gold and its Investment Properties, and we would ask that you fill out the survey following the presentation. If you'd like a hard copy of the report mailed out, please provide us with the address. The replay for today's presentation will be made available by Friday on our website. And for more information on Wainwright Economics, Alliance Trust, or Bullion Management Group, please visit us at our events page at bmgbullion.com/events for the links to the appropriate websites. Thank you.
Thank you for joining us. Currently on your screen, there is a survey. We ask that you please fill the survey out for feedback purposes. This concludes the live broadcast of Gold is for Real Wealth Preservation, Not Speculation, presented by Bullion Management Group, Incorporated. Replay of this webinar will be available at www.bmgbullion.com on Friday, March 11th.